Long-term investing is a crucial component of any financial strategy. Long-term investments provide the chance to build wealth by taking advantage of the increase in value of one's assets over time. The optimal course of action will rely on the specific financial requirements and goals of each individual investor from among the different techniques and assets available. While no single approach works best for everyone, many people are able to maximize their return on investment through diversifying their portfolio and considering the potential risks and rewards. Before starting, don't forget to like and subscribe to the Financial Tech channel for more future updates. Let's begin, then. Mutual funds. Mutual funds are investment vehicles that are run and managed by seasoned financial experts. They are collective sums of money from a variety of different investors used to buy stock, bonds, and other assets from companies. Financial institutions generally sell and administer mutual funds, and investors hold tiny portions of the whole fund. Since mutual funds are often low cost, diversified, and well managed, they are seen as a simple method to invest. One of the most well-liked investing options for both retail and institutional investors is mutual funds. They let buyers to make a single investment into diverse portfolios. This implies that a person may buy a range of assets, including stocks, bonds, and other securities, for the same amount of money. This kind of diversity gives investors a practical approach to raise their potential profits while lowering the risk of loss. Stocks. The equity investment known as stocks signifies a share or a portion of ownership in a publicly traded corporation. Investors who buy stocks are admitted as shareholders in the business. They have certain rights as a shareholder, including dividend payments, the ability to cast a vote on significant corporate decisions, and the right to a share of the proceeds in the event that the business is sold or liquidated. Because they can often be purchased or sold rapidly and are often liquid, stocks are a popular alternative for investors. Additionally, they provide the chance for monetary profits and capital appreciation for investors. Stock prices change according on the company's and the market's performance. Investors should be aware that stocks may be risky investments and that their values might fluctuate up and down. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are investment vehicles that are managed by qualified money managers and traded on stock exchanges. Shares of stocks, bonds, and other instruments comprise them. ETFs are distinct from mutual funds in that they are traded like stocks on the stock market, while mutual funds provide investors a diversified portfolio. ETFs often have minimal costs and provide the possibility of capital growth, dividend income, and capital gains, which is one of their key advantages. Additionally, they let investors to spread their money across many markets and sectors. ETFs may also provide investors a way to hedge their assets and get protection from market volatility. Real estate. Residential and commercial properties are only two examples of the many diverse investments that fall under the asset class of real estate. Real estate investments may be quite profitable and provide investors the chance to make money by renting out the property or by selling it for a profit. Since real estate is less volatile than stocks and bonds and is less impacted by market fluctuations, it may be an excellent method to diversify a portfolio. Through rental income or capital growth, it may also provide investors both short and long-term income. Bonds. Bonds are debt assets that may be bought by individuals as well as companies, who often utilize them to finance operations. An investor who purchases a bond is effectively lending money to a business or the government. In return, the bond's issuer will provide the investor recurring interest payments for the duration of the bond. Since bonds are often seen as low-risk investments, they are a wonderful method to diversify a portfolio of investments. Over the course of the bond's existence, they may be able to provide investors consistent income in the form of interest payments. Bonds may also be sold before they mature, giving investors the opportunity to benefit from changes in interest rates or to sell their investment early. Treasury Inflation Protected Securities, TIPS. Treasury Inflation Protected Securities, TIPS, are a particular kind of U.S. government bond that aim to shield investors from the impacts of inflation. The U.S. Treasury Department issues TIPS which are backed by the full faith and credit of the American government. The Consumer Price Track, CPI, a gauge of inflation, is used to track both the principal and interest payments. The payouts on the index increase in tandem with CPI. Since the bond's payments will fluctuate in pace with inflation, TIPS are designed to provide investors a hedge against price increases. Certificate of Deposit, CD. Banks and credit unions provide a specific kind of savings account known as a Certificate of Deposit, CD. CDs are deposits that have a certain holding duration, often several months or years, and pay interest at a set rate. Given that they are FDIC insured and provide a return on your investment, CDs are regarded as a secure and dependable kind of investment. When you purchase a CD, you are expected to keep the funds in the account for the term, which is the length of time. You won't be able to access or withdraw the money during this period without paying a fee. Due to this lack of liquidity, CDs often provide greater interest rates than other kinds of savings accounts. Commodities. Physical items utilized as inputs in the creation of other products and services are referred to as commodities. Items like oil, gold, silver, wheat, and cattle are among them. Investors may purchase and sell commodities via exchanges. Commodities trading may provide diversity and high return potential to investors. Since supply and demand determine commodity prices, an item's price may rise when demand rises. Because of this, commodities may be a desirable investment for those seeking to hedge against inflation. Annuities. Insurance products called annuities are intended to offer retirement income. They provide a guaranteed stream of income for a certain length of time and are used as a kind of savings vehicle. When you buy an annuity, you pay the insurance provider a single amount in return for a series of consistent payments throughout the course of your retirement. Cryptocurrencies. Digital, decentralized assets that may be used to make payments are known as cryptocurrencies. Based on blockchain technology, they are independent of any centralized authority. Investors have access to an alternate asset class that is unrelated to conventional markets thanks to cryptocurrencies. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.